All right, fellow meme stock traders, XMAX Trading here. Go ahead and hit the subscribe button if you haven't already. So I'm going to go over some interesting information regarding stock trading. Not financial advice, just my opinion. And let's get started. SEC chairman says banning payment for order flow is on the table. Wow, pretty amazing. August 30th. The controversial practice that has brought in billions of dollars to brokers and high-frequency trading firms is in the crosshairs of the SEC and could be eliminated entirely, which is done in Europe, I think. In an interview with Barron's on Monday, SEC chairman Gary Gensler said a full ban of payment for order flows on the table is a practice where brokers and traders trade orders to market makers to execute those trades in return for the portion of the profits. Gensler said the practice is an inherent conflict of interest. Market makers make a small spread on each trade, but that's not all they get. They get the data. They get the first look. They get the match off of buyers and sellers out of the order flow. And he said that might have been the most efficient for the market of the 2020s. He didn't say where the agency has found instances of those conflict of interest, resulting in harm to investors. SEC staff is reviewing the practice and could come out with proposals in the coming months. Gensler has mentioned several times that the UK, Australia, and Canada forbid this, and asked if he raises those examples because the ban would also happen in the U.S. You're probably, I'm raising it because on the table, this is very clear. And it's not the only thing SEC is considering. Also on the table is how do we have much more market transparency, aka get rid of dark pools. Transparency benefits competition and efficiency of markets. Transparency benefits investors. Payment for order flows is part of a much larger issue of market structure that Gensler is trying to solve. He notes about half the tradings in dark pools, sometimes more than half, right, for AMC and other stocks. Half the tradings in dark pools, internalized by companies who keep those trades off exchanges. Even some of the trading that takes place on the exchanges is opaque, and exchanges are paid through rebates that are similar to payment for order flow. Opaque markets, where different investors have their trades processed differently, has potential for abuse. It provides an opportunity for the market maker to make more, and ultimately the investing public to get a little bit less when they sell or have to pay more when they buy. It also affects how companies are raising money, and it could be a barrier to fair, orderly, and efficient markets. The changes to payment order flow may take place as a larger reshuffling of how trades are processed and tracked. There's been a boom in retail trading the past 2 years, Barron notes, with millions of new investors signing into brokerage apps to trade stocks, options, cryptocurrencies for the first time. The boom has been driven in part by a change in the way brokers make money on customer trading. Most brokers no longer charge for trades up front. They make money off of trades by sending orders to the market makers at high-frequency trading firms. The market maker executes the trade and profits off the difference between the bid and ask prices, sending part of the profit back to the broker. Most brokers, which I didn't know, practice a small part of their business model, often less than 10% of revenue. But Robinhood, good old Hood, is about 80%. And shares of Robinhood were going down lower today, end of day. The company told investors that securities filing the SEC's focus on payment for order flow is a risk factor, but company executives have played down the possibility of it being banned. Our view, in terms of we don't expect payment for order flow to be banned. He added, we do think payment for order flow is such a small stream of revenue, about 2.5 cents per $100 traded. It's not terribly different revenue for us to replace. SEC found that those fractions of pennies do add up. In fact, the agency settled allegations with Robinhood last year, how it negotiated payment for order flow and disclosure to its customers. The agency said Robinhood made deals from 2015 to 2018 with market makers that gave the company a much higher percentage of the spread, whereas brokers generally gave more of the spread back to the customers. Robinhood's been very naughty. SEC and Robinhood negotiated 80-20 split, where the company uses 80%, investors get 20%, whereas other brokers, it's 20-80. Regulators said that Robinhood's trade execution was so bad for consumers that it outweighed the benefit of not having to pay a commission. To settle allegations, Robinhood agreed to pay $65 million, but neither admitted nor denied findings. The company also said it changed its payment for order flow practices. Proponents of payment for order flow said it's a way for brokers to make money that doesn't hurt consumers and allows apps to charge zero commissions. These are the reason people have started investing, according to the CFO. No one before has been investing in this country has been cheaper. Never before has it been cheaper to invest in this country. He also noted that other brokers have historically accepted paying for order flow on top of commissions, whereas Robinhood never charged commissions. And any change to this practice would clearly be contentious. We will be definitely defending our customers, make sure we don't put up barriers that have been taken down and kept people out, CFO said. Yeah, they're doing it for their own benefit. Robinhood management is on this, through this number of issues, has failed to instill much confidence, failed to recognize payment for order flow prospectus. No one believes they'll do any better. The other issue with the payment for order flow is you take away the payment part, it still gets routed to the market makers. They don't have to pay for it anymore. So we need choices how our trades are routed, even if it means we pay more to buy and get less when we sell. It won't be front-runted by the market makers and potentially hurt, because whenever you buy a stock, it always seems to go down, huh? All right, guys, till next time, later.